Hello everyone, this is Jim Martens. I'm co-editor of Elliott Wave International's Pro Service. Well, you know the old saying, a trend in motion stays in motion, or the trend is your friend. And when you look at this chart of 10-year notes, you can see the trend. It's to the downside and has been for quite some time. But the question is, how do you know when the trend is complete? And when any of those bounces along the way down occurred, how would you know that movement was going to prove corrective instead of representing the resumption possibly of a larger trend? Well, the wave principle helps me make those decisions. I want to walk you through this example of how we knew before that last bounce on the right side of the chart occurred that it would prove corrective. So I'm going to start counting as we do from the top. The trend is down, so that we suspect the decline will be impulsive, so we're counting with numbers. And as you can see, I started off with a 1, 2. So again, that means the trend is to the downside and it's going to continue until I can count to 5. Now, from that 2, there was a decline and then a recovery. Well, that recovery overlapped the end of wave 1. And that meant that I needed to count another 1, 2. So wave 3, that's the green circle 3, was subdividing into 5 waves of its own. And if I'm counting 1, 2, 1, 2, the wave principle tells me that the market in question, in this case 10-year notes, should stage an extended decline, a strong decline. And we know that because third waves within impulsive movements typically represent the extended wave, the strongest move in the sequence. And if we're counting within wave 3, 1, 2, that means we're counting a third of third wave, so it should be stronger still. And we saw the market bottom and then the rebound in question. Now, again, if I'm trying to count to 5 and even 5 waves within wave 3, I already have an inclination that the rise should prove corrective. And if I was to channel the movement on the way down, that is, and by doing that, by connecting the end of wave 1 of 3 with the end of wave 3 of 3 and drawing a parallel line off the top of wave 2 of 3, I already had an idea of where this correction might end, somewhere just above 120. And you can see in this example that ultimately that is where the recovery did end. But the wave principle is about structure. Just as we've been counting structure to the downside, 1, 2, 1, 2, 3 of 3, we can count the structure of that recovery. If it's a corrective recovery, it should end in 3 waves. It is counter trend. So when we drop down to a lower degree chart, in this case I'm looking at a 4-hour chart, picking it up from the low at 116.29, here's the structure of that recovery, which ended at 120.20. An initial ABC movement was clear. That's a zigzag, probably the simplest of the corrective patterns that R.N. Elliott identified. It was followed by a 3-wave setback and a second ABC rise. We call this pattern a double zigzag. It's a corrective pattern. So that fell in line with the idea that the rise should prove corrective, which it did, ending near the upper channel line, and the market has subsequently fallen to a new low. But as you've probably gathered by this point, we don't believe the decline is complete. And that's what we're following now in Elliott Wave International's Interest Rate Pro Service, following the internal structure of wave 5 to the downside. It should too unfold in 5 waves. And we'll stick with the trend until the market shows us evidence that we should do otherwise. And we'll be watching the short-term charts to try to find evidence a reversal has occurred. But based on the structure we're showing here, the next rebound is also, like the one before, likely to prove corrective.